Hello, welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again is Pepperstone's Senior Market Strategist, Michael Brown. Hello, Michael.
Very good afternoon to you, mate. How you doing?
Good, mate. Good, mate. I'm slightly DMARP happy. Obviously, this will be the last podcast until the 12th of September. You're on holiday next week, and obviously I'm off as well for the next 2.5 weeks. So, yes, got quite a bit to cover, even though it has been quiet, slightly quiet market-wise. Typical thin holiday market. Mixed week. US market's a little bit softer. FTSE 100, another record high, 9,300. Happy days. Got anything to sort of comment on? Obviously, there's a talk about a modest spot of vertigo-led profit taking on AI concerns, which we'll go into slightly more detail. But other than that, there's not really much to say this week, is there? Apart from obviously Jackson Hole.
No, absolutely that. I think you're spot on. Obviously, we'll get onto the AI stuff in a second. I think it's an interesting one because if tech stocks have really struggled and started to roll over, but they've come a very long way in a very short space of time since the bottom in April. It feels like a little bit of profit taking, which, as you said, in a very, very thin market, typical of the summer period, with people also wanting to take risk off the table before we hear from Powell at Jackson Hole. I don't think it's anything more than that, to be completely honest with you. The usual suspects have come out claiming that the end is supposedly nigh and, this is the end of the bull run. Far from it. These sort of pullbacks and little bumps in the road are actually a healthy part of a bull market. So, I think once we navigate the risk that Powell's remarks present at the end of the week, I think that investors will be buying the dip in relatively short order, I would expect.
We had the Fed minutes last night. Obviously, we'll talk about them after the risk warning. But again, you said to me off camera that they came across as slightly hawkish, even though there were two dissenters for a rate cut. So I'd like you to explain that after we've done the risk warning, because I must admit I haven't read the minutes because I thought Jackson Hole was much more important.
I thought you were going to say because you've got better things to do, which actually would have been an equally valid excuse, mate.
Indeed. And obviously also Trump and the Fed remain centre stage. Yeah. So we'll talk about that a little bit as well. But risk warning, here we go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 73.7% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so that's out the way. Obviously we touched upon the opening topics. What's driving markets this week? Record highs for the FTSE, Jackson Hole, US stock markets suffering a bit of vertigo. Obviously that MIT report on corporate AI projects, we'll talk about that. We'll talk about one of your favourite topics, the Office of National Statistics.
Oh, good.
I noticed you come with a laundry list of gripes.
I'm prepared this week.
Yeah, so I've actually forgot the swear jar, but never mind. But we'll talk about obviously the UK economic numbers, the CPI. Good news from the flash PMIs. Good news from public sector borrowing as well. Maybe Rachel Reeves won't have to signal more tax cuts in her October budget.
Maybe pigs will fly.
Well, maybe I'll get the little going anyway. Jackson Hole, obviously, we'll talk about that. And this week's earnings announcements from Walmart. Bit of a negative reaction to that on the US Open. A little bit puzzled by that. Home Depot. Again, another fairly decent set of numbers there. Target disappointed again. And in terms of the employment picture, we had the full year numbers from Hayes. So we'll talk about that before looking ahead to next week. Obviously the bigger one, and I think you can see sort of bring the curtain down on earnings season with Nvidia.
Yeah.
Obviously, I think that's the topic du jour for next week. We do have second quarter GDP out of the US, but that's not really going to tell us anything we don't already know. Consumer confidence numbers out of the US PCE, spending. Will any of this data signal, rubber stamp, or what have you, a possible 25 basis point rate cut from the Fed in September? Remains to be seen. And obviously we have JD Sports from the UK and their second quarter numbers as well.
Yes.
So let's get started, shall we?
Where do you want to start?
FTSE 100, new record highs, 9,300. Somewhat bizarrely, it's diverging from pretty much every other market. That's by making new record highs. European markets are doing nothing. Zedsville, Arizona. US markets having a little bit of a tantrum, albeit in very thin market conditions.
Yeah. It's odd. I'm not going to lie to you. It is a weird one. The FTSE very much bucking the sort of broader global trend, as you said. But, I suppose when you dig into it a little bit more, as we discussed off camera, off mic, before we started the podcast, the sell-off that we've seen has been very much a tech-led sell-off. And actually, if you dig into certain other areas of the market, on Tuesday, for example, well over half the S&P 500 actually ended the day in the green, despite the benchmark falling over 1%. The Dow was, which I hate, but it has been relatively resilient. And one of the things that we've spent years moaning about when it comes to the London market is there's no tech stocks here. So I wonder whether actually that's now in this sort of mini microcosm, it's become almost an advantage, because actually what we're seeing is potentially a rotation out of the tech sector and into some of the more value oriented names, which is what the FTSE is full of. So that is really the only logical and semi-coherent explanation that I can come up with to explain why the FTSE is trading where it is. It's certainly not anything sterling related. The pound hasn't moved especially much this week. It's certainly not anything policy related. I mean, if anything, the data we've had this week would argue for a more hawkish stance from the Bank of England. I think it's purely just this sort of sector rotation play that we're seeing pan out.
And 70% of FTSE 100 earnings come from overseas. So,
yes.
It's not really reflective of the UK economy per se.
No, not at all. Which we've obviously got to be careful of all the time, because the FTSE. We always say the stock market is not the economy. I think probably in the FTSE 100's case, that's probably more apt than anything else, given the degree of revenue that it generates from overseas. But the sell-off in the tech sector interests me, because I'm kind of sat here going, it's simply, we've come a very long way in a very short space of time. We've got all of these stocks that are up 80, 90, 100 more % from the bottom that we saw in April. Is it kind of just overdue that we get a bit of a pullback with some froth coming off the top of the market, and that's just what we're seeing this week?
Am I right in thinking, and I think I read it somewhere, and it made me raise my eyebrows, 40% of the S&P is made up of the Magnificent Seven. Is that right in terms of market cap? It's
that right? About that, yeah. I think.
I mean, that's just staggering.
It is, but I don't subscribe to the camp that should be a reason for worry or for concern on its own. If you this is a discussion I think we've probably had before, and I think I've certainly had it before, is Mag 7, it's not just tech companies anymore. Amazon are all over the place, Apple are all over the place, Meta absolutely everywhere, Alphabet as well, of course. It's sort of, it feels a bit lazy these days to go, oh, it's just tech propping the market up. Well, it is tech, and take Amazon for example. Yeah, they generate a huge proportion of their revenues from cloud, but they also do e-commerce. So probably there are some people out there who probably use Amazon more than they do their local supermarket.
And also Walmart and Amazon are the two biggest US retailers.
Yeah, exactly. So I think is it unusual? Yes. Is it unprecedented? Probably. Is it worrying? Not really. It just feels a bit of a lazy narrative, in all honesty.
Okay, so let's talk about it. This report from researchers at MIT has said that corporate AI projects are so far generating zero returns for business now. And then when you've had Sam Altman, ChatGPT owner, OpenAI, has also weighed in, saying that some investors were becoming overexcited about AI in general now. Yeah, that may be true. But is it that concerning that corporate AI projects are so far generating zero returns for business? To my mind, these decisions take time to pay off. In the same way that mass redundancies can be expensive upfront in terms of payoffs and compensation, but in the long term, might offer savings in the form of more streamlined and automated operations. Isn't that essentially what we're seeing here? An awful lot of upfront costs with, at the moment, zero return on investment, with the intention of generating a return of investment 5 or 10 years down the line.
Yeah, I think you're absolutely right. I mean, if you sort of take it back right to the bare bones, you're talking about AI, an open AI with Sam Altman. ChatGPT launched in what, late 2022, early 2023. And I think probably for the first 6 months of it, the majority of people, myself included, were just, one, in awe of what it could do, and two, frankly, just kind of messing around with it quite a lot, just to see what the technology can do. So it's really only the last kind of 18 months or so that that these models have got to a point where they're actually usable, but also where businesses have been able to assess, firstly, what investments they need to make into the space, but also where these bits of technology can actually be of use to their operations. And you're absolutely right. It's not something that's going to pay off immediately. It's something that's going to pan out over the next 5 to 10 years, if not longer. And I'm almost surprised that people are surprised that we've got that it hasn't had a payoff yet. I mean, of course it hasn't. No business in the world can implement anything and expect it to work flawlessly and bring all of these cost savings and productivity benefits the very next day. That's simply not how the world works, whether it be AI, whether it be, introducing a new set of laptops for everyone, whatever it may be. These things take time for the full dividends to actually bear fruit.
Well, it's like drilling a new oil well or a gas well.
Yes.
There's a sunk cost that goes into that. And then in the case, and then over the course of the 5, 10, 15, 20 years, you get a return on that investment.
Yeah,
So,
and I think it's just it's fair enough. And these researchers at MIT have obviously got to have something to keep themselves busy all day long. But I'd almost be more shocked if there was a payoff just yet. And I think to sit there and go, there's been no payoff now, that's the whole thing dead and buried. Let's put all the nails in the coffin. That's a very, very short-sighted view to take, I think.
I think it's symptomatic of the instant gratification type of society that we're currently in. People want something and they want it now. Well, unfortunately, the world doesn't work that way.
Yeah.
Sometimes you have to put in an awful lot of work, an awful lot of time and effort and investment before bringing a new product to market, and there will be hiccups along the way.
Yeah, and it takes some patience to see the benefits pan out.
Yeah, exactly. And unfortunately, patience, I think, is something that is in very short supply.
Sadly.
I think certainly now it is. And I find that incredibly disappointing, because essentially what that means is that no one takes the time and effort to develop a decent product.
Yeah, and actually, I think there's two sort of sides to that story. One is, you're absolutely right. No firm seems to actually develop a product to the fullest extent it can do, but also consumers probably are happy to be just upgrading and changing their products all the bloody time, effectively.
And this is Apple's problem.
So the firm adapts to consumer demand, essentially.
Yeah. The problem with that is, if there's something new does come out, that firm then gets left behind. So you get a situation at the end of the 90s where Apple slipped into irrelevancy, and now it's running the risk that it could well do the same thing unless it starts to move on before, beyond the hardware that it's currently very, very good at. It's good at it, and its revenue, it certainly generates an awful lot of revenue. But where's the next big product coming from? But that's Apple's. That problem is specific to Apple at the moment.
Yes,
but there is a slowdown. There has been some talk of a slowdown in hiring on AI, because I think Meta announced they were suspending hiring on AI-related projects. But given the fact they're spending about $100 billion a year on that, I think you can sort of forgive them that a bit.
Well, yeah, and also, of course, the other thing is Meta. Probably about 2 weeks ago, there were all these headlines about them offering various AI engineers 9-figure salaries. So I wonder whether someone in their finance department has sort of turned around and gone, guys, how are we paying for this? But again, a hiring slowdown when you're investing that much, is it a big deal? I'd argue absolutely not.
Right. Okay, so that's basically our thoughts on these AI headlines and the weakness that we've seen. I'm not concerned at the moment because, as I say, we're not really seeing any significant sell-off.
Yeah.
I think the real test will come in September when an awful lot of other factors are likely to come into play.
Yeah.
Ultimately, the next Fed meeting.
Yeah.
And obviously Trump's relationship with the Fed, because let's move on to that now.
Well, I was just going to say, but before we do, I said sort of on your the same note there. I said sort of semi-jokingly on the internet yesterday. Everyone's panicking. The S&P and the Nasdaq are basically back where they were 2 weeks ago. It's not that big of a move in the grand scheme of things. It's the opposite direction to the one we've been traveling in for the last 4 months. Yes, but this is far from anything to worry about just yet, I think. But you're absolutely right. We do need to move on. We do need to talk about the Fed because Mr. Trump has lost it again.
Yeah, but I mean, you say that. I mean, the DAX is back where it was in May. But the DAX has gone nowhere since May. So consolidation is nothing new. You should not fear consolidation.
Yeah, that's very true.
Anyway, so Mr. Trump turned his attention to Lisa Cook, another Fed governor, another Biden appointee. He seems to be taking aim, let me just be clear about this. Trump is not having a go at Lisa Cook. Someone else is. And he's weighed in saying that she needs to resign because of concerns about mortgages or a mortgage application that she put in. I mean, this must be very unsettling in terms of central bank policy making, because if you keep moving through the governors, it's interesting to note that he hasn't targeted a regional Fed president. It's just the governors. So he's got Powell. Obviously, Lisa Cook is the most recent Biden appointee, appointed in 2024.
Kugler resigned, of course.
Kugler resigned, yeah. And there's talk that obviously he may temporarily. Who did he appoint as a temporary replacement?
Steve Moran is. But he's not going to, isn't he?
But he's not going to. It's not permanent, is he? Or he's not being guaranteed the position.
No, he's going to be there until the end of Jan, and then someone else will replace him, presumably.
It's hardly worth it, is it?
Well,
anyway, I'm digressing slightly. Obviously, having failed to unseat Powell, now they're looking at maybe other dominoes in the pack.
Yeah, I mean, I think we need to be a little bit careful what we say, given that it potentially involves some allegations of felonies that have been.
But that's all it is. It's allegations. It's nothing more.
Exactly that. And we should also stress that Lisa Cook has denied these allegations as well. I think on a sort of broader level, it speaks to the Trump administration's continued desire to erode the independence of the Fed. You can argue whether or not prior Feds under prior presidents have been independent or not. I think the difference this time around is they're not even trying to hide the fact that they want to take over the Fed. It's effectively a pressure campaign. We are going to go through absolutely everything you have ever done before and make your life a complete misery unless you do what we want, which is ideally quit. If you're not going to quit, vote for a rate cut. That effectively seems to be the message from the Trump administration here. It's something we've seen playing out for a while now. It's something that it seems likely is going to play out for some time to come. The interesting potential implication of all of this is, obviously, we mentioned Steve Moran, who Trump is trying to put on the Fed board. He's already got Chris Waller and Michelle Bowman, who he put on the board in his first term. So he's got 3 out of the 7 board members as his people effectively right now. If Cook were to leave, then that's 4. If Powell were to leave as a governor, then that's 5.
Well, he did appoint Powell.
He did appoint Powell, yes. As much as he probably regrets that, he did appoint Powell. So I think it's it is clearly worrying. The president is trying to exert greater control over monetary policy. Monetary policy independence is there for a reason, and I think it again calls into question, the credibility of things like the dollar, and increases the attractiveness of things like gold, which almost feels like a rerun of the conversation we had 3 months ago when Trump first started saying, too late, Powell needs to cut rates, or whatever nonsense it was at the time.
Yeah, I mean this conversation about the dollar. I was watching Bloomberg this morning, and someone was suggesting that we could see euro dollar at 130. I don't know what he'd been smoking, but that seemed remarkably optimistic to me, given the fact that that would signal a significant deterioration in sentiment
Yeah.
towards the greenback as a, as a reserve currency.
I think you'd also that would also get the ECB quite nervous as well.
Yeah, exactly.
They've already said 120 could be a problem, so 130. I mean, that will probably cause some sort of seizure in Frankfurt.
Well, you would think so, given the quality of the data that's coming out of Europe at the moment. So with respect to Jackson Hole and Powell's speech,
yes,
which
that's
is due
coming up
Friday
tomorrow
afternoon. Hopefully this podcast will be live by then. There's been loads of speculation. Is he going to throw the market a bone? Because September last year, the Fed cut by 50 basis points. And they then cut again, I think in November and December.
Yeah, they did.
But they haven't cut this year at all. They're the only G7 central banks who have not cut rates this year.
Well, don't say that. Trump will be on the blower, ringing you up to become Fed chair at that rate. I'm glad you mentioned last year, though, because actually I think it's worthwhile recapping what Powell said at Jackson Hole last year. And I've got the quote in front of me. The key line in his address this time 12 months ago was, and I quote, "The time has come for policy to adjust. The direction of travel is clear. The timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks." That's what Jay Powell said at Jackson Hole in August of 2024. And as you said, the Fed then went on to cut 50 basis points that September. I do not think he is going to say anything anywhere near as explicit as that this time around. I think you're probably going to get a message very much in keeping with what he outlined at the July FOMC decision, where the current policy stance is well positioned. There's two-sided risks to the mandate, and stressing that they are on a journey back towards neutral, but when and how big those steps are, that's going to depend on the data. I think one sort of hallmark of Powell's chairmanship at the Fed has been pragmatism, has been this kind of data-dependent wait-and-see approach. This isn't a new thing. I don't know why, at a time of incredibly high uncertainty, and with the August jobs and inflation data still to come before that meeting, why Powell would effectively abandon that stance, throw caution to the wind, and endorse the fact that they'll deliver a rate cut in September. I think he'll keep the flexibility, keep the option on the table that they might cut, but for the market currently pricing an 80% chance that they will, I think that should probably be nearer 50-50, if not slightly under that, ahead of the key data that we get, which will determine ultimately what they do. I think the Doves are going to be disappointed, frankly.
Yeah, I mean, I was looking at some CPI numbers earlier this week, and it was as a broader part of a piece I was writing on the UK economy, a copy of which is on my Substack, which I posted yesterday. But inflation in the US in July last year was 2.9%. It's now 2.7%. So it's modestly lower. And that's despite 100 basis points of rate cuts, all which came at the end in the second half of last year.
Yeah.
So he could probably get away with a 25. The big question is, what message would that send? Yeah,
and I think the other issue is when you start, it's difficult to stop. No giggling at the back. But if Powell and the Fed were to go 25 in September, it would be very tough to then at the November meeting say we're back on pause again. That would be a very tough message. And I think Atlanta Fed President Bostic said similar today in some prepared remarks, essentially along the lines of, when we resume cutting, we want to just carry on in that direction until we reach neutral, until we reach the terminal rate. You really don't want to go down this path of kind of stop-start monetary policy. So I think, again, it just sort of encourages the Fed to err on the side of caution and err on the side of waiting longer.
Well, I think those recent PPI numbers as well, I think are going to make them think twice about being overly dovish, because that was a big jump in July.
Yeah.
It was a 1% jump year on year. It went from 2.6% to 3.6%. And if PPI is a leading indicator of CPI, you don't really want to be doing that.
No, and I think also a lot of other comments from the Fed have been quite telling recently. A number of officials have been talking about the break-even payrolls rate, which is basically the pace at which the US economy needs to add jobs in order for that to keep pace with growth in the labor force. A lot of Fed officials are saying that that's around 50,000. Now, for context, that was probably about 200,000 a couple of years ago. It's so much lower due to changes in immigration policy. But if the break-even payrolls rate is 50K, give or take, then actually, in the context of that, the jobs data we've had recently doesn't actually look too bad. Plus, a lot of Fed officials say we should be looking at the unemployment rate, not looking at payrolls growth. Well, if you look at the unemployment rate, unemployment's been below 4.5% for 45 months. That you would look at that and go, we're at maximum employment. Yeah, there are downside risks, but right now we're at maximum employment. So there's a lot of moving parts, clearly. I don't think we're going to get any sort of explicit guide from Powell or from any of his colleagues as to where policy goes in September. There's simply too much uncertainty and too much data to come before that meeting for them to pre-commit now.
I think there's also something else we need to bear in mind between now and the next Fed meeting. And last week I talked about it, and unfortunately I said it wrong. Basically, the BLS didn't increase the jobs forecast by
the benchmark revision.
Yeah, they cut it by 800,000 just before the election. Now, September the 9th, I believe, they're doing another host of revisions for the jobs data for this year.
Yeah.
Which should give us a fresh idea of how many jobs have been added over the past 8 to 9 months. So that could be a significant indicator, and it could contribute significant market volatility. Yeah. I think it's September the 9th. I don't know whether you can check that for me.
I will when we finish recording.
Yeah, the BLS will be basically posting a host of revisions for all of this year's jobs data.
Yeah, and just before anyone puts their tinfoil hat on, the BLS do this every year. It's an annual benchmark, preliminary benchmark revision to employment, as it was in the March of the year that they are announcing the data for. Obviously, a certain orange man in the Oval Office will not. If it's revised up, then it's going to be the best thing ever, and it still means they need to cut rates. If it's revised down, then he's just appointed a new head of the BLS, but I suppose he'll be on the chopping block less than a month into his term.
Yeah. The poor old BLS. They're getting as bad a rap as the ONS, which moves us swiftly on. Which moves us swiftly on. What a segue.
Let me throw a tenner in the square jar. Hang on.
From the BLS to the ONS. Okay, so the Office of National Statistics, easy for me to say, is under fire again this week. Go. The floor is yours. Retail sales.
God, yeah. I mean, we'll cover the actual data in a second, but you're absolutely right. The soap opera of the Office for National Statistics continues. This week we had news that the retail sales figures that we were meant to be getting on Friday morning, referencing July, they are going to be delayed until the 5th of September because the ONS need to conduct further data quality assurance.
How bad are they?
Well, I was going to say, to translate that into English, it basically means they've cocked it up and they need to fix an error. Now, frequent listeners of both of our work will know this is not the first time that the ONS have had an issue with their data, and I've compiled a list of other data series with which the ONS have had issues over the last 2 years. Of course, this all started with the labour market statistics in mid-2023 that still haven't been fixed, and they say that might take until 2027 to get accurate jobs data here in the UK. That's not all, though. Since then, the ONS have also had issues in compiling consumer price inflation with the vehicle excise issues this April. They aren't able to produce accurate trade statistics, nor are they able to produce accurate PPI numbers. They've also had to suspend publication of household wealth data, household income data, personal well-being statistics, figures relating to the UK population, data on life expectancy within the UK, statistics on smoking habits within the UK, and the quarterly regional GDP data that they are also unable to produce. That's quite a long list. I would argue that that is not the biggest issue. The biggest issue with all of this is actually, can we trust anything that they say? Because these are the series that I've been able to find that the ONS have admitted they've got problems with. Given how pervasive those issues are, what other issues are there out there that the ONS haven't actually found yet, that they don't know about, and that are still skewing the data that they are releasing? Frankly, it's become a complete and utter shambles. It is a scandal, and I don't use that word lightly. There should be much more outrage about it. But one thing I will do, and I don't do this very often, is I will cut a tiny little bit of slack for both the Bank of England and His Majesty's Treasury, because they do have a very difficult job. Yes, they are both making an absolute pig's ear of that at the moment, but their job is being made harder because the folk down in Newport, South Wales, are unable to give them accurate statistics about what's going on in the economy. So you're trying to make policy while you're flying blind, effectively. It's an absolute mess, and there seems to be no sign of it getting better anytime soon.
Yeah, I think it makes sense then for the Bank of England to start investing in its own models, and they've certainly been doing that. But I think you're right. I mean, you look at what the Office of National I can't even say it. The Office of National Statistics it has one job,
and it can't do it.
Yeah.
And actually, you're right. The BOE have started. The BOE have basically had to build their own data set, which comprises not for the labour market, which takes the ONS data, but also various other data sources. And that's what they're now using, so that policymakers have got half an idea what's going on. Now, I'm sure the Bank of England know much more about this than I do, but I would argue that there's much better things that people at the BOE can be doing than recreating statistics that are supposed to be accurate. That just seems like a complete duplication of work. Let's tackle the root cause. Let's have, proper overhaul of the ONS, and then that will solve the issues, as opposed to trying to work around what is frankly an absolute mess of a statistical agency right now.
Yeah, sadly, I think that the problems at the ONS are not confined to the ONS. They're symptomatic of a broader malaise in the public institutions of this country, where a lot of them are just not fit for purpose. They're not run along the lines of a private sector business, which I think they should be. People should be held to account for errors. They're not. They should be able to meet targets, and they're not meeting them. And ultimately, there just appears to be no accountability. It just appears to be a case of, I'm going to turn up, get my paycheck, and go home. Well, sorry, we, as economic forecasters and basically analysers of markets, expect more than that, particularly 100%. With the amount of taxes we're paying. Anyway, moving on.
We'll come down off our soapboxes now, because we have actually had some data. Obviously, take it with a huge pinch of salt, but we have had some data this week.
So CPI, UK CPI, it's not good news.
No, it's not at all. Coming in hot once again and continuing to move in the wrong direction, away from the Bank of England's 2% target. Headline CPI in July coming in at 3.8%, which is up from the 3.6% we saw in June, and also the fastest rate of headline inflation in 18 months. When you dig further into the data, core prices, when you strip out food and energy, that rose by 3.8% on the year. year, which is the fastest pace since April, and services inflation, which is sort of a gauge of sticky prices, for want of a better word, that rose by 5%, up from a prior 4.7%. Now, of course, there has been the usual round of trying to explain all of this away with various one-off factors, one of which being airfares, but frankly, every month there seems to be a different one-off factor that's pushing inflation higher. Food prices are up even further. The crux of the matter is inflation is high. It's getting higher. It's going to 4% by September, and it's moving further and further away from the bank's target. And I think in light of that data, the four hawks who dissented against the August rate cut are looking like they made the right decision.
I think it was the right decision. I mean, to be quite honest with you, I look at UK inflation and I compare it to the US inflation and EU inflation. Okay, in July 2024, US inflation was 2.9%. It's now 2.7%. EU inflation was 2.6% in July 2024. It's now 2%. UK inflation was 2.2% in July 2024, went as low as 1.7% in September, and it's now 3.8%, approaching 4%. Yet the Bank of England has cut rates in that time 5 times.
Yeah.
Why?
Well, the other thing, of course, to remember is, and I think you made this point last week, we are probably 2 months away from having a negative real bank rate. And what I mean by that is effectively CPI will be higher than bank rate is. Obviously the BOE say we're going to peak at 4. I'd argue risks to that are tilted firmly to the upside now, given where we are. The other little nugget that I found out this week, digging into the BOE's latest forecast that they published in August, is although they've put in those forecasts that inflation will peak at 4%, they've also made the assumption that despite inflation moving to that level, it will have no impact whatsoever in terms of spilling over into demands for higher wages, which seems folly to me.
How can they possibly know that? And obviously with the public sector, that's a complete...
Well, I mean, I said to you literally before we start recording, the Tube are now going on a strike for higher pay. So again, the BOE, it feels like that's a bit of a mistake in their forecasts, and that further tilts inflation risks to the upside. Not good on the price side of things. But then the PMI numbers that we had this morning, a 12-month high on the services metric, a 12-month high on the composite output metric as well. So maybe things aren't as bad as we're making out.
Yeah, I mean, I looked at those PMIs, the flash PMIs. There was a strong improvement in August services. It's a 12-month high of 53.6, driven primarily by an improvement in new work. Manufacturing, though, went the other way. That continues to struggle. But there was something in the report that did worry me somewhat. Yes, there is an improvement in the services sector, but hiring trends have continued to slow.
Yeah,
little to reassure the Bank of England, and another monthly decline in the workforce, the 11th month in a row. And cost inflation also edged higher as companies passed on the recent increases in national insurance and other related costs. Now, this line caught my eye. I'm going to read it to you. August data also indicated a sharp and accelerated rise in average cost burdens across the private sector economy. The rate of input price inflation was the highest since May, reflecting stronger cost pressures in both the manufacturing and services sector. So that is a headwind going forward. Yes, it has brought public sector borrowing down, those national insurance increases, as a consequence in July. But the bigger question for me is whether that can continue. And there were some interesting trends in those public sector borrowing numbers. I wonder whether you want to go into them.
Yeah, I mean, I think just on the PMIs, the details are certainly not as pleasing as the headline would imply. I think that's the key takeaway there. On the public borrowing numbers, obviously the deficit at 1 billion as near as makes no difference in July, which was basically half of where consensus had foreseen it.
Lowest July figure for 3 years.
Yeah, and I think this is really interesting because for those who are unaware, the deficit in July in the UK, the monthly deficit, is always relatively narrow. And the reason for that is a lot of self-assessment tax returns are paid in July for whatever reason. And that obviously means that the Treasury's tax take is much higher, which means the monthly deficit is narrower. Now, the reason why I think that is important this year is because in April, we had a change to national insurance contributions where employer contributions went up quite significantly. And obviously in the run up to that and in the aftermath of that, we've seen a very, very big decline in the number of employees on PAYE payrolls, pay as you earn, effectively how employers pay tax for us here in the UK. A lot of that, or the assumption was, well, if people are coming off PAYE payrolls, they're losing their jobs. Actually, there's potentially an argument that says, yes, some of them likely, sadly, have lost their jobs because unemployment has moved higher, but also a proportion of them may have become self-employed, may have become contractors as a way for businesses within the UK to get around these changes to employer national insurance. So I think that's probably a trend that bears paying some attention to. What I would also say is, sadly, despite your slight optimism earlier on, it doesn't change the game for Rachel Reeves. We are still looking at significant tax hikes and fiscal tightening in the budget. Well, I was going to say the autumn budget, but it feels like it's going to be a winter budget at this point. I was talking about this with a mate of mine on the train this morning.
Listen, mate, I was trying to put lipstick on a pig here. Cut me some slack.
The OBR want 10 weeks in order to produce their forecasts for a major fiscal event at a minimum. Now, 10 weeks from today is the last day of October. Ideally, the OBR want 12 weeks, which is mid-November. Mid-November would be a very, very, very late budget. I get the feeling that Rachel Reeves is sort of sat there trying to put this announcement off for as long as possible to basically hope and pray that a miracle turns up to save her bacon in the meantime, which, to quote something an old boss of mine told me a long time ago, hope is not a strategy.
I'd scrap the OBR.
Well, so would I, but
It's not
sadly they're seen as sacrosanct by this lot.
Well, no, they weren't sacrosanct before George Osborne brought them into being.
Yeah, I mean, it was a mistake. It was a complete mistake.
Well, I think what it was basically a mechanism by which you have an independent arbiter, which allows someone to run the rule over, government spending plans. And it was brought in as, sort of a way to basically beat Labour with. And now, unfortunately, I think they've outlived their usefulness. And to my mind, it's just another pointless quango.
Well, I think they've been sort of elevated beyond their station, for want of a better word, because, there is absolutely no harm in having a body that sort of basically checks the government's workings when it comes to their maths. The problem is when we treat them as if they're some sort of godlike institution.
But they're also funded by public money. So
there's a lot of conflict of interest. And frankly, actually, what the OBR say, yes, it's important, but the bigger issue is right now, given that we're so dependent on borrowing, is does the market believe the government has credibility? And right now, given where the 10 and the 30-year gilt are sitting, I would say the message is unequivocally the market does not believe the government has any credibility and its fiscal plans are not worth the paper that they're written on.
Well, as Sean Richards is always fond of saying on social media, the only rule of OBR Club is that they're always wrong.
Yeah, exactly. And
Anyway.
And he is right. But the problem with that is, just to finish up on that, the problem with them always being wrong is when we're operating with such narrow margins of fiscal headroom, even them being wrong by a modicum is going to throw everything out of whack. And that's why we end up in this doom loop that we're now stuck in. But anyway, we're going to depress ourselves as we carry on with that.
Anyway, I mean, so basically there's a mixed bag of numbers this week, some good, some bad. They point to an economy that, while slowing, isn't quite ready to keel over quite yet, but certainly I think the second half is likely to be a lot weaker than what we saw in the first half.
Yes, indeed.
And that makes the Bank of England's job in terms of potentially delivering another 2 rate cuts this year much more difficult.
Yes, I would fully agree with that.
Okay, let's move on. Hayes, the employment agency, full-year numbers, and that sort of segues into what you were saying about PAYE and people going over to contracting, because their set of numbers, and they weren't particularly great, and the shares are down 2% today. Like for like, net fees decreased 11% to £972.4 million, and a 56% decline in operating profit. But what they did deliver was quite interesting in terms of temp and contracting fees were down by 7%, but the permanent side of the business saw a 17% fall, with momentum slowing further in the final quarter of this year. So that reinforces your point that people are contracting in preference to taking on, or businesses are taking on contractors as opposed to taking on permanent employees.
Yeah, and actually Hayes said that the chief exec said that in the commentary surrounding the results, talking about challenging market conditions and how placement volumes have decreased. And it just generally didn't paint a particularly optimistic picture of the recruitment market here in the UK, to be completely honest.
Yeah, he called it the great hesitation, in quotation marks, with a 20% decline more than offsetting a 3% increase in average pricing. Yeah. And the company has been cutting its cost base. It's declined its cost base by £6 million over the last 12 months, but it still didn't stop it from seeing a 56% decline in operating profits. So that sort of gives you an indication into the hiring trends, not only here in the UK, but globally as well.
Yeah, and also this is where you can infer more from an earnings report about the economy than you can necessarily. It's not just a case of what does it tell us about that company. It's also the broader message, which I suppose, without wanting to throw your running order out, brings us on to the US retailers.
It does, and it doesn't throw my running order out because it basically brings us straight onto that.
It's almost like we rehearse.
Yeah, almost. No, this is very much off the cuff. I mean, there is a running order, but,
that I haven't seen, actually.
Yeah, I'm sorry about that. I did mean to send it to you. But yeah, we've got Target, Walmart and Home Depot. Target, disappointing. Or the market reaction was disappointing. The numbers actually weren't anything to write home about, but they certainly weren't disappointing. But they plunged despite beating on expectations on revenues and profits for Q2. But they kept their guidance unchanged, and they appointed Michael Fidelka as CEO. And I don't think the market's like that.
No, I don't think they do. And I wonder whether that's because they've effectively appointed an insider as the CEO, as opposed to getting someone in with a fresh set of eyes. I mean, this chap is not only an insider from the perspective of he's the COO, he's an insider from the perspective of I think he spent his entire career there, which is fair play to him for climbing the corporate ladder, but it's clearly not what the market wanted to see. And I think if I'm right in saying, I think it was the 11th straight quarter of either flat or declining sales for Target. I think the appointment of the new CEO, it leaves the market going, well, is your message here more of the same? Because the same clearly is not working. We want something different. You haven't provided us with something different. And I think that's why the stock has extended on its declines. I mean, we're down 30% on the year. We're probably even more than that now.
You're right. Overall trends, annual sales have been flatlining for the last few years. So there's been no sales growth at all at Target for the last few years.
Yeah.
Contrast that with Walmart and Home Depot, and solid set of numbers. Home Depot, bit of a roller coaster ride on their shares on the Tuesday in the aftermath of their numbers, because they fell sharply in the pre-market, but they've since recovered quite nicely from that sell-off. Net sales up 4.9%. Profits narrowly missed, and I think that's probably why the market was a little bit disappointed, but they're still fairly decent. Full year outlook of 2.8% sales growth and a company sales growth of 1%, so they kept that unchanged.
Yeah.
So basically, if you actually look at where the market was on Friday and where it is now, very little change.
And of course, that's in the context of a broader market which has endured a little bit of a slump, as we were alluding to right at the top of the show. So actually, in that context, that performance is not too bad at all. And the earnings weren't particularly shabby either. A little bit softer than expected in terms of top and bottom line performance, but certainly nothing worth worrying about, I don't think.
I think one of the things that Home Depot has done recently, they're the equivalent to B&Q. I know I always say that, but for any new, but for any
I
new
want
viewers,
a pound every time he says that, then I could retire.
Yeah, but I mean, digging into the numbers, what they've done is they've diversified the business. So the recent acquisitions have meant that Home Depot now gets 55% of its sales from professional businesses and 45% from the retail market.
Yeah.
And it was the acquisition of SRS Distribution last year for $18.3 billion, which was a supplier to roofing and landscaping professionals, helping the sales mix and maintaining that resilience.
Yeah. The other thing actually on Home Depot, I'm going to use the English pronunciation of them, is their outlook, interestingly, assumes that there is no changes to monetary policy over the course of the remainder of the year. The reason why I bring that up is because obviously the market's pricing 50 basis points of cuts from the Fed. If you were to see potentially a looser stance, if that were to maybe, juice the housing market a little bit, then that obviously introduces an upside risk to the guidance that they've already issued.
Actually, new home sales were out while we were on air.
They were pretty decent, weren't they?
They were pretty decent, up 2%.
Yeah.
So, yeah, I mean, house sales can always be a little bit flaky and choppy, but a resilient housing market will always help those sorts of retailers.
Absolutely.
Walmart, market doesn't like them at all. Down 4% at the moment as I'm talking to you. Came in below forecasts on profits, but they were still up on last year, 1.5% increase on last year. And revenues up 4.8%. What's not to like?
Yeah, I find this a bit of a head scratcher, to be completely honest with you. As you said, sales were up, same store sales up 4.6%. They raised their net sales guidance as well. I don't see anything really in these numbers. I must admit, I have only had a sort of cursory glance at them, but even at that sort of top level look, I don't really see any reason why you'd be marking the stock down 4 or 5% based on the earnings that they've reported pre-market. The firm is doing relatively well. Clearly, they've upgraded their guidance. They're optimistic, and by extension, you would extrapolate that to say the US consumer should be doing relatively well. I'm struggling to understand why the market is taking such a pessimistic view of this.
Yeah, gross margins are up 4 basis points, led by Walmart US, with strong growth in e-commerce of 26%, as well as in store.
Yeah,
I think they're coming under pressure from the Trump administration to eat some of the tariff costs. And maybe that could be well reflected. Maybe they'll come under pressure to cut prices. But I think that's really the only reason I can see to be overly concerned about this particular fall in the Walmart share price. Okay, so let's move on. Next week we haven't really got an awful lot on. We've got US PCE spending, US second quarter GDP.
Which is a revision. So
which is a revision to
we can shrug that off.
The 3% number that we saw at the end of July. Consumer confidence, always a little bit flaky. This is not the Michigan ones, though. I think they come at the end of the week.
Yeah.
For August, that slid to a 5-year low in April, but it's recovered fairly positively since, though it is still below 100. So, and it was above 100 at the start of the year. Rising food prices, concerns over sticky inflation, taking some of the edge off. But looking at personal spending on the part of the US consumer, there's only been 2 negative months. One in January when it was really, really cold, and one in May in the aftermath of obviously April tariff tantrum.
Yeah, and it just goes back to that old saying, never bet against the US consumer. And that just continues to ring true, doesn't it?
It does indeed. Okay, let's look at JD Sports second quarter numbers on the 27th. Those shares have finally stopped falling, and they do now appear to be enjoying a little bit of a turnaround. Having said that, they're down 2.8% today, but
just as you put the kibosh on things,
but they're close to the highs that we've seen since May, and each dip has been bought into. Each low has got progressively higher.
Yes.
And I think a large part of that is down to the fact that obviously Nike is starting to show signs of a little bit of a turnaround. Also, some US sports retailers are also starting to perform an awful lot better. We've got Dick's Sporting Goods next week as well, who basically recently acquired Foot Locker in the US, $2.4 billion there to increase their international exposure. That deal is supposed to close in the second half of this year. So I'm hoping the good news on part of JD Sports, because they've also got a big US operation. They bought Hibbett, which was a US fashion retailer. Again, we fell as low as 62p in April, just shy of its COVID lows at 55. 100p has got to be the next target for JD Sports, surely.
You would imagine so, and I think Well, you've told me here that is the price target that Deutsche have now slapped on the name, which is
Yes.
probably partly behind some of the recent optimism. But yeah, it does seem like things are becoming more constructive, as you said, since we reached that bottom in the aftermath of Liberation Day at the start of April. It hasn't been one-way traffic, but it has been a series of higher highs and higher lows, which is obviously what you want to see. Are these earnings going to be the catalyst to give the stock its next leg higher? I think that's what participants are going to be focused on. But given the external leads, you would say things bode relatively well.
Yeah, indeed. We've also got Best Buy, Q2 numbers 27th. Again, electrical retailer, US equivalent to Currys, has also been forming reasonably well because of growth in the sales of computing tablets and mobile phones.
Yeah.
Which have been doing reasonably well. Nvidia.
I was going to say they're the big one, aren't they, next week?
Yeah, the Nvidia. So Nvidia is the big one. Let's finish off with that for our break. They've been enjoying the rarefied air of in excess of $4 trillion valuation, but they've sold off quite a bit. What do you reckon for Q2?
Well, I think that actually the earnings, all else being equal, you would imagine that the Q2 earnings from Nvidia are going to be very, very positive and relatively strong indeed. As we were chatting about before we turned our mics on to record the podcast, pretty much every firm involved in the AI space went through their Q2 earnings call saying, we are seeing a return on our investment. We are raising our investment and our capital expenditure in this arena. Who is going to benefit from that increased capital expenditure? It's the semiconductor names like Nvidia, like Broadcom, who report in a couple of weeks' time, et cetera, et cetera. So the only issue for Nvidia from a trading perspective, from a stock perspective, is even though we have had this little pullback in recent weeks, or in recent days, I should say, is the stock at a point where it's kind of priced to perfection and the bar for post-earnings gains is so high because optimism is so high that it's almost impossible to reach. But if you take that out of the equation and just think about the numbers themselves, I struggle to see any reason why they would be disappointing.
Indeed. I mean, the share price has dropped back towards its 50-day moving average, which is around about $165. It's been, moving steadily higher pretty much since March. There's little evidence at the moment of a top unless we drop below 160.
Yeah.
And let's look at the expectations. Q2 guidance was for $45 billion in revenue, plus or minus 2%. Jensen Huang saying that the company was seeing strong demand for its chips, with estimates for Q2 expected to see a modest increase in gross margins to 72%. So 45 billion plus or minus 2%, 72 gross margins, and it also reflects an estimated $8 billion loss in H2 revenue due to the new US restrictions on China.
Yes.
And obviously it's diversifying its customer base, setting up AI hubs in Saudi Arabia, UAE, with fancy names like Humane and Stargate. So, Nvidia Q2 2026 earnings 27th of August.
Yeah, and I guess there are some question marks over the whole China situation, particularly with the sort of quid pro quo where they might be giving a chunk of their revenue to the Trump administration, which I have no doubt will feature on the earnings call. But I was talking about this with a client the other day. The alternative, there's basically two options, it seems. Either they don't sell any chips, or they sell some chips and give a chunk of the revenue to the Trump administration, which is far from ideal. But they can just raise their prices if they need to cover that cost. So I'm not sure it's a worrying sign, but I'm not sure it's a game changer for the firm. But as you say, that's the big one to watch next week, and that is basically the end of earnings season.
Indeed, and obviously you can talk about FedEx and Nike and what have you, but there are obviously good indicators for logistics and consumer buying patterns, spending patterns, and what have you. So certainly look at them, but we won't be around for those two because we'll be both on holiday.
Putting our feet up somewhere.
Not together, mind you.
No, before that ends up in the Daily Mail.
Separately. So on that note, ladies and gentlemen, thank you very much for your company. And we'll see you all again September the 12th.
Indeed.
With a pre-look at Federal Reserve, Bank of England and Bank of Japan. should be
Yes.
very interesting given what might happen over the course of the next 2 or 3 weeks. Anyway, until then, thanks very much, and see you all in September.
Bye for now.